bring in. I see. So welcome folks to insurance as an asset class. Today we have with us Uriah, and Uriah's calling in from the Raymond James Financial Planning Department at the Kelowna office. Uriah was born in Duncan, BC. He graduated from Mount Royal University in Calgary with a bachelor's degree in policy studies, with a minor in Spanish. Uriah decided to pursue a career in financial services based on his keen interest in finance and estate tax planning. In addition to his four-year bachelor's degree, and since joining the industry, he successfully completed the Life License Qualification Program, the LQP, exempt market product curriculum, the compliance officer training, the Canadian Investments Funds course, and in addition, he also holds the esteemed Certified Financial Planner CFP designation, as well as the Chartered Life Underwriter designations. So we are in good company today. Um, and Uriah likes to spend his time going back and forth between investment advisors, accountants, tax lawyers, and corporate business planners, kind of coming up with all of these ways to reduce the overall tax bill, which is, I think, the name of the game for those of our clients that are joining today. So with that, I'll pass it off to you, Uriah, and let you go through the slides. Just a quick little bit of housekeeping for folks. There will be a recording of this presentation, so if you want to review it later, if you get pulled away or you want to review one of the parts of the presentation or share it with someone, more than welcome to share it with friends and family as well. Getting this stuff, we've recently did individual pension plans, retirement compensation agreements. We've talked about life insurance strategies for kids and trust funds. I'm working right now on getting all of this stuff up and running on a YouTube channel as well, so that people will be able to go in and pick and choose and get caught up on some of these advanced strategies. So stay tuned for that. With that, I'll pass it off to you, Uriah. Lights, camera, action. I'm going to mute myself and turn my camera off so I'm not a distraction.
Okay, great. Greg, it's a pleasure. And to your listeners and your clients that are joining us today, thanks for taking some time to be with us. Hopefully, this will be good content for you.
Yeah,
Um,
one more quick thing I almost forgot. There is a question and answer button at the
yeah,
bottom of the screen. If anybody watching has questions during the presentation, feel free to hit that Q&A button and type those in anytime. I'll get to answering all those questions and asking Uriah for answers at the end.
yeah, great. Again, it's a pleasure to be with everybody. Greg gave me the instructions, so let's maybe take 20 minutes, 25 minutes, to just kind of share a few ideas with the listeners today about the type of advice that I'm being brought in to kind of provide and set up for business owners who've had a lot of success, and they've followed really good accounting advice, which would suggest kind of pull out of their holding companies or their operating companies the money that they need, either as salary or dividends to kind of pay for lifestyle. But there's a pretty common consensus across all of the accounting firms that I've worked with that retain your excess or keep your excess retained earnings at the corporate level, and that there's a bit of a tax deferral benefit to keeping the money corporately versus holding it personally. And so, look forward to kind of sharing with you some of the ideas that we've been seeing in the trenches, working with business owners and entrepreneurs and incorporated medical professionals and that kind of thing. The firm has me now working across 5 provinces. And as one of the senior kind of insurance, estate, and tax planning specialists, I get the opportunity to work with teams and clients and their accountants across the country. And this idea of setting up a life insurance policy, and I'm going to use kind of the time today to specifically look at this strategy inside of a holding company. What we're seeing from an organizational chart standpoint is Very common, holding company is kind of the goose egg that's providing the prosperity, and any excess retained earnings kind of flow up to a holding company. And in that holding company, the business owners are hoping that holding company ultimately becomes their, in many cases, retirement nest egg. A lot of the time, the business owners are preparing and prepping the business for sale, and hopefully there's a share sale that triggers a lifetime capital gains exemption, so that some of the growth from the valuation of the business can at least be triggered tax free. Sometimes we'll see trust or family trusts above the holding company, which is above the operating company, and all sorts of different org charts. But today, the going to keep it simple to setting up this strategy, this tax shelter, this insurance policy, and the holding company, and how we're advising clients to do that. And I use my words very strategically. Insurance as an asset class. That's a really kind of specific wording. And for a lot of the business owners, most of the business owners we work with, insurance for risk management planning is not what they need. They've got more than enough to self-insure. Very few of them have debt. If they do, there's other sizable assets against that debt, either personally or corporately. But most of the time they're in great shape financially, not good shape. But with that prosperity, with that success comes um, two tax problems that we're going to kind of talk about today as we go through the slides, and look forward to kind of sharing that with you. My background is as kind of an estate tax financial planning specialist, and I always look forward to working with business owners, and more specifically their accountants. So what are the challenges facing those business owners as that success builds, and as that prosperity and as that capital builds inside of a holding company? There's typically, a couple of different issues that they need to be aware of. And so this is really what I kind of want to touch on here in the first few slides we've seen quite a bit of tax reform take place over the last number of years, most specifically 2017 through 2019. And we saw quite a bit of tax reform being introduced by the former Trudeau Liberal government, targeting holding companies. And so for those of you on the call, you likely would have had conversations with your accountants around these tax on split income rules, and what are we allowed to kind of pay a spouse or a family member that we had been paying previously out of the company. And there's a whole set of rules to justify how and where and when we're allowed to pay those family members. But the end result of that tax reform was some new rules and punitive rules around the taxation of investments that were held passively, and a reduction in what we call the small business deduction rate on the first 500,000 that businesses are earning. And really, it was just a focus on business owners. And there's certainly a sentiment, my opinion, but there's certainly a sentiment that would suggest that from the Department of Finance and the sitting federal government, that somehow business owners are not paying their fair share, and that we should be taxing kind of rich people more. And I don't subscribe to that. And a lot of the business owners and accountants we're meeting with are frustrated by that ideology, and they're looking for ways to kind of tax shelter their money. And this idea of using a life insurance policy is how we do that. There's two tax problems that business owners have as they build their wealth. Tax problem number one is on growth. Now, this is not a new concept for most of the people we meet with. If you have a stock bond mutual fund portfolio that your advisor is managing on your behalf at the corporate level, and you can do that, and we're seeing most of the clients, in a situation like that. Depending on how and where the wealth management team has you invested, you're going to see those T3 and T5 tax slips. Those are getting ready to go out later this month. And that represents kind of the growth and the taxation on the growth, depending on the type of investments you hold. And different investments have different taxation outcomes. If I hold foreign dividend income, or if I hold rental income or interest income, that is taxed, in Alberta at 46.67%, in BC 50.67%. But this idea that 50% of the growth of our investments could be taxed is a thing. Now, there is something called the refundable dividend tax on hand, or if you pay yourself a dividend, you get some of that tax back. I really won't get into the kind of the nuts and bolts and details of that today. But really, what I want to stress here is that taxation problem number one is taxation on the growth of our passive assets as they build over time. There's also a second tax problem, and that second tax problem is the one that most people don't fully understand. We ask business owners, what is your net worth? Most people will give us a very accurate number of what that number might be. But when we pose a slightly different question, hey, if your estate or your executor had to settle your estates and there was tax to pay on your personal and registered assets, do you know what your net estate value would be after the CRA had received its tax? Very few people actually know that number. And in fact, as we work with the accounting firms, and I've worked with KPMG and Deloitte and Myers, Norris Penny, MNP, and BDO, and a bunch of very very successful and efficient, small and medium sized independent accounting firms. They're not doing those projections for business owners, and I'm surprised at how many of the accountants I meet with don't even know, what the current estate tax liability problem is, let alone the future one. And so that's really kind of where I set the stage of this idea of what and how do we address those two tax problems, and getting advice on those tax issues, and how do we kind of navigate, and is there a solution that we can look at that can address both of those tax problems? And I'm happy to report that there is a solution. And that's the idea of setting up a life insurance policy at the corporate level that can be overfunded, that can then create some growth, and there's tax efficiency in doing that. And who would have thought, right? That, like, setting up a life insurance policy and providing a blood sample and going through some medical history questions, and providing kind of some medical history to get approved for these structures could lead to one of the most tax efficient ways for business owners to continue to grow their wealth. But through that process, structured properly and customized, we can eliminate taxation, eliminate volatility, and certainly ensure that there's a larger estate value later. I'll show you some numbers in a few minutes on a case study that we're currently working with. And there's also this ability, if the clients are alive, that they could actually even use that insurance policy as a pension style income stream while they're alive if they needed it. And so we look forward to kind of, planting the seeds today and sharing a few ideas with you. If you have questions at the end, I look forward to answering them. And if there was even an interest in scheduling some one-on-ones after this, certainly Greg and I would make ourselves available. So I've set the stage here. What are our options as we look to put that money to work for us? Some business owners will shareholder loan money back down to the opco from the holdco. Others, recognize that, their wealth is concentrated in the operations of the operating company. They want to kind of separate and create some other passive assets, which are held at the holdco level. And what's the advice on the street that's being given on how and where to put that money? Well, here's a couple of strategies that we're normally seeing. And one strategy suggests that just continue kind of funding your stock bond mutual fund portfolio in your corporate account, and unless you're earning over 50,000 in passive income off of that, there is no tax to pay and there is no ramifications to that growth. Don't worry about it. So just keep building corporately. Scenario two is you have the ability to depending on how and where that stock mutual fund portfolio is invested, there is the ability to kind of incorporate some tax efficient structures at the mutual fund level that can create a return of capital that's pretty tax efficient. So we're seeing some advisory teams incorporate that inside of their corporate investment strategy. And number three is the scenario that I see a lot of with accountants, where they'll suggest, hey, just pull the money out, either as salary or dividends, and then reinvest that into your RSP. And we can trigger an offsetting tax deduction on your personal tax return, even though you are drawing some income out. And even at the dividend rates now, the good old days of paying 25% on that dividend income are long gone. And what we're seeing now is much higher taxation on, ineligible dividends coming out of the corporation, as business owners use that as the strategy to fund their lifestyle. And the other thing that I'm running into is a lot of business owners are not super keen on that, Greg, as a strategy, because what it does is it ties up those assets. It's no longer available in the corporate org chart to be able to kind of deploy back into the business if something were to happen. There is a whole fourth solution called individual pension plans. It sounds like with your clients, you've already kind of introduced that concept. And in the right circumstances, it's a very, very viable strategy. The only thing that's interesting about IPPs is, again, you're kind of setting up almost like a defined benefit pension strategy for yourself as the business owner, and you're able to make much larger contributions into that IPP strategy. And not only can you do that, those contributions are tax deductible to the holding company, which is fantastic. The only challenge with those IPPs and some of the financial plans I've worked on is that they're kind of locked away and they're illiquid and inaccessible by design. Now there are some tax rules that came into effect going back to 10 years ago that allow for some income splitting on that IPP strategy, but it's all taxable T4R income when the business owner does decide to kind of access that later. The last strategy, this idea of setting up a life insurance policy in the corporation, is really the one that we wanted to focus on today. And so at this point, I like to kind of pause for a second and really kind of just touch on what I like to refer to as the three musketeers. There's only three prominent Canadian tax shelters left. One is our principal residence. As a side note, I spent some time in the U.S. this past weekend with some family, and it was interesting kind of comparing notes. They're able to write off the interest on their mortgage payment, but when they go to sell their principal residence, there is a taxation event there. And so, we in Canada can't write off the interest on our mortgage, but to know that that property, as it appreciates over time, if at some point in the future we want to sell it and downsize when we get older, to know that all of that growth was completely tax exempt is, an important part of many plans that we work on. The second strategy is tax-free savings accounts. Most of you will be familiar with that concept, and we love tax-free savings accounts. I remember when they were first introduced in 2009. $5,000 each. It was such an insignificant amount of money for most plans that we didn't spend a whole lot of time focusing on it. But now, with well over six figures of contribution room for both spouses, that could become a very prominent tax shelter strategy for Canadians that we're looking at more closely. The third and final musketeer, this good-looking fellow on the far right-hand side, this idea of setting up permanent cash value life insurance. And the point I want to make here is you can set that strategy up personally, but the fact that we can also do it in the holding company really kind of separates it from its two colleagues, because the principal residence and tax-free savings account, both of those concepts are on the personal side of the financial planning ledger, not inside the corporation. As we continue on, introducing this idea of this insurance as an asset class strategy. How does the concept work? Well, like I said, what we're able to do is set up a policy where the corporation, the holding company, is the owner, the payor, and the beneficiary of the policy, and the business owners or the shareholders of the corporation are the life insured. And by setting that up and structuring it, what we're able to do is actually, beyond just the cost of insurance, we can actually overfund the policy. We did see some tax reform come into effect at the end of 2016 that kind of tinkered a little bit with what we can put in as an over contribution, but there's still some very, very healthy room in what we can put in. And as a result of that, what we have this ability to do is we can take these investments and we can start overfunding that policy, and we can actually start building an investment inside of that contract. Now, for the purposes of this conversation, again, I won't get into some of the differences between the product structures that we have available to us in the industry to set the strategy up. There's two predominant platforms, one called Universal Life, the other one called Participating Whole Life Insurance, and that's the one that we're typically using in 9 out of 10 cases. And the reason we like it is because the insurance company is the one that's managing that portfolio, and it is predominantly invested in real estate, mortgages, and bonds. And so we're seeing a correlation with some clients where their investment teams, guess what they have them invested in? Some real estate REITs or mortgage investment corps, and PIMCO bond ETFs and Canadian banks and dividends in those spaces. But all of those are generating those T3 and T5 tax slips I was talking about earlier. In this strategy, there is no T3 or T5 tax slip that's ever being issued from the insurance carrier to the holding company. And as that investment account builds, we're customizing the strategy where as early as the 7th year or the 6th year or 8th year, the amount of money that the business owner has stroked as a check to the insurance company is that policy's cash value now. And that is a very important threshold to cross over from a financial planning standpoint. Because at that point, if you think about it, the insurance policy could now be viewed like a tax-free savings account hybrid inside of the corporation. We're funding almost like a non-correlated asset class. Another wealth management team that Greg Wood, in conjunction with Uriah, has added in as part of a broader asset allocation conversation. And we love these strategies because, in to their credit, the largest insurance companies in this country that offer these products, Manulife, Sun Life, Canada Life, you will have heard of these companies. They've been managing these participating whole life insurance portfolios since the 1800s. And in that time, they've proven to be very good in their stewardship of managing that portfolio. And based on how we structure the strategy, we can make sure that the growth of the policy is vested and locked in, and that there is never any risk of volatility in the portfolio. There's never been a client at Manulife or Sun Life or Canada Life that's had one of these participating whole life insurance products that has ever opened up a statement and seen a cash value that was less than the previous year. That's really critically important because a lot of the business owners we deal with, they're happy to take risks in their businesses, but if they relinquish some of that control and they're getting advice on how and where to grow that money, many of them come in at kind of a balanced or a moderate, risk tolerance profile. And some of them like using GICs, and this becomes an amazing GIC alternative that we can get double the yield on top of this massive estate planning benefit that pays out on the client's passing. And so in short, that's kind of how the strategy works. Excuse me, I'm just checking my time clock here quickly. And what we have basically is once the policy is in place, it's almost like a Swiss Army knife. There's a number of different applications that we can look at. Two that I wanted to spend a couple of minutes looking at here is this idea of using the policy as what we call an estate bond. And a second concept, where we're using that policy to generate that pension style income stream that I was talking about. So, I'm going to use an actual case study here. We've stripped out the clients' names and we've implemented a picture that's not them, but this is an actual case study that we're working on here in British Columbia as we speak. Clients are in their mid 50s with a couple of children, and so estate planning is important to them. They have a combined net worth of 4.8 million, with 3.5 of that personally held and 1.35 corporately held. Some of that 3.5 million came from the sale of a small business that triggered a capital dividend credit that allowed them to pull some of the money from the sale out. And at the end of the day, as we've looked at their overall situation, what we've estimated is that they have a tax liability based on the slide here of about $1 million currently. So their net worth isn't 4.8 million, it's 3.8. And really what they were interested in and what we're looking at is, how do we grow our wealth tax efficiently, reduce taxes to the estate, and maybe leave more to our kids. And that's ultimately, a common objective for most of the clients that we look at once we've been able to show them through our financial planning process that they have enough to fund their retirement planning. And so in this situation, again, back to my little strategy here, what we ended up doing was setting up a policy. And in this case, we recommended 70,000 a year for 10 years. And based on their $1.3 million investment account, which, to the advisor team's credit, they were getting them 8 to 10% over the past 10 years. All that we were doing was reallocating some of the difference, reallocating some of the growth off of their passive investments held in the holding company into this strategy. And the argument goes like this: hey, your money's going to outlive you. We went through a full financial planning process. They're going to be great. But recognizing that their net worth is maintained and in fact growing slightly, and recognizing that there will be money left in the corporation, at life expectancy, which we take out to age 95 now in our projection models, it became apparent that, they were going to have more than enough than they needed, and in fact weren't really using their corporate account at all. And so the argument was, what if we set up one of these strategies, we funded it from the growth off of your portfolio, and we set that up as a 10-year payment schedule, and now we were able to kind of repurpose some of the capital into a structure that will allow that to grow tax-free and pay out, significantly tax-free from a CDA credit down the road. And when we compare kind of a balanced portfolio, which is what you're seeing on the screen here at the top, versus setting up this insurance strategy as an asset class, predominantly invested in real estate, mortgages, and bonds that's managed by the insurance carrier. The end result was a significant difference. We're able to run models and do comparison reports for clients and accountants. And the end result was, an estate value of 3.6 million versus 1.7 million, as a result of this $70,000 over 10 years being not invested in the planning versus using the tax shelter strategy. So that ended up being almost a $1.9 million benefit to their estate. I can't understate enough how important the planning is, because the argument we made to these clients is, look, like, you're going to be around a long time. That's the highest probability scenario. And if your money needs to sit somewhere, if your capital needs to be parked somewhere for the next 20 or 30 years, why not repurpose a portion of it into this planning strategy, and we can grow it tax free for you? That is the estate bond strategy. And at the end of the day, this idea that we can make sure that money is transferring intergenerationally as tax efficient as possible for a lot of clients is important after we know that, or after they know that they're going to be okay to fund their own retirement. The last concept I'll share with you in the few minutes I have left is, what if, as opposed to using that policy to transfer to the kids, what if we used it to generate a pension style income stream? And, in this second strategy, we have a whole separate set of tax calculators that we can run for clients, and money in can be money out. And we like sharing this, as part of the education process with business owners, because in the absence of this explanation, it's easy for some of them to just think, man, I'm just cutting a check and that's an expense. And, the kids are just going to get more money. And some business owners feel that their kids are already corrupted by their success and their wealth. But what we'll tell them is, hey, look, in the absence of any planning, we can show you what's going to go to the CRA. And most people at the end of the day are more interested in looking at more tax efficient ways to structure their investments so that either philanthropy or their family can benefit. Because ultimately, that's what, the argument we're making is, there's three different groups or factions that are going to be potential benefactors of your estate. It can be family, it can be philanthropy, or it will be the government. And so, this strategy that I'm showing you on the screen here was a slightly different concept that we shared with these business owners, that they could put money in. And so we ran a scenario where they funded it for 10 years at 70 grand a year with corporate capital. But then we also ran a scenario where they were then pulling money out of the corporation for 15 years later on in life. And to think that they funded the strategy at $700,000, but were able to then generate out to themselves $1.5 million as a pension style income stream. And now, there wasn't almost 2 million going to the estate, but 1 million to the estate. They love that idea. So, at the end of the day, once that policy's been set up, we can look at a couple of different ways to kind of structure it to either flow through the wealth to generation number two, or we can use it to kind of generate a secondary retirement cash flow lifestyle stream while they're alive. And that concept is not one that most people are acutely familiar with. And that's where my role is in working with the accountants to kind of structure that. I've got this kind of just summarizes that idea that with just that GIC strategy, 70,000 over 10 years, they could generate $832,000 as net cash flow to themselves, and really nothing else to show for it at the end. Whereas, because of the tax efficiency of this structure I keep referring to, 70,000 a year could generate $930,000 out over 15 years, and there's still $1 million to the estate. And the most probably impressive part of the entire planning is, in addition to having $1 million left over, we're still able to create a $3.5 million CDA credit to their estate. In most of these plans, we're reallocating the growth. All of the core capital is still sitting in the corporation when they pass away. And so to be able to generate a $3.5 million CDA credit on top of the pension and $1 million in cash that's left over, there's really, it's from a tax planning standpoint, it's a head and shoulders above kind of just the status quo. Um, at this point, that's really all I wanted to share. In summary, this idea that we can set up insurance as an asset class, we have the ability to overfund it to build an investment inside it, and that strategy single-handedly with one product recommendation generates the potential to address both the tax on growth and tax on death issues that every business owner and successful entrepreneur has if they've accumulated wealth at the holding company level. With that, Greg, I'm happy to take any questions that might have come out based on kind of my comments here over the last 20 minutes.
Thanks, you great job. Appreciate
Thank you.
lots of good idea sparking concepts there for sure.
Yeah,
Uh,
hopefully.
we'll dive into some questions here, and then
Okay.
if there was any other parts of that or high level stuff you wanted to cover, we still got plenty of time.
Perfect. Yeah, yeah, yeah.
First question I have is I already have one set up from 2012-ish.
Yep.
How much more can I buy for insurance, and then how much can I over contribute?
Okay, great question. I appreciate that question. I have many more questions as a result of that question. If that strategy has been set up, it depends on how it was structured, right? The illustration scenario that I was showing assumed a 10 payment schedule. So, from 2026 to 2035 kind of thing. So if that policy was set up in 2012, we're going back a little ways now, right? We're going back 14 years. And so was it a universal life insurance policy versus participating whole life insurance? It's an important question because what that means is, what was the payment schedule? In some cases, here's the answer to the question. In some cases, we've had clients where we kind of encourage them to set up the strategy for 10 years, but then they wanted to keep funding it in year 11 and year 12 and year 13. That might be the scenario in this case with your client, depending on what they have in there. If it's a universal life insurance product structure, there might be the potential for even larger lump sum contributions on the front end. There's more flexibility with the universal life side of things, but because we set up our policies using participating whole life insurance, we're really maxing out what they can put in as an over contribution every year. So that does limit or create some limitations to what we can do as an over contribution if we wanted or had a client who had a bumper crop year in their business and wanted to add more to it. Based on how we set those up, there's some limitations to what we can put in as more. I don't know if that
Perfect.
answered that
I,
question,
I
but
think I think the answer is maybe book a follow-up call with Uriah.
yeah, and what will happen in scenarios like that, Greg, is even if the client had a copy of their statement, we're happy to just kind of take a look at it and with one policy summary or annual premium or policy statement, that'll give us all the details we need to kind of help the client navigate it. What I appreciated most about the question is that in many cases we're meeting with business owners that already have some of this planning in place. It's just been set up on a smaller scale because the people that set up that strategy previously may not have gone through the same financial planning analytics to figure out what the client's estate tax liability is. So we've
And
encouraged them
people's
to take the time.
situations change over time too. Their their
100%.
their needs will change over a 10-year time period as well.
Yeah, so there's two files I'm thinking right off the top of my head right now where the advice was, hey, we're glad to see that these policies have been set up. Keep these policies. These are good policies, but let's maybe kind of see if we can't rebuild or get a second policy in place to kind of give us the coverage that we need. Because even in a scenario where they can put more into it, there's some limits to what they can do there, and sometimes that doesn't give them the coverage for their state tax liability, if that makes sense.
For sure. Next question. What is the CDA limit and how is that created?
Yeah, really good question. And depending on your clients that are on this call, we're using a very different set of words and vernacular here, right? The CDA credit, capital dividend account. There's only two ways you can create a capital dividend account, and that's either through proceeds and payouts from a life insurance policy, or if I owned a building, that I bought for 1 million and I sold it for 2 million, just using simple numbers here. And I sold the building for 2 million. My adjusted cost base is 1 million, so I get that back. But half of that growth I get to keep. The other half is then taxed. The half that I get to keep, it creates a CDA ledger entry. And so that really speaks to kind of a broader concept in accounting called integration, where whether I held that real estate property personally or corporately, half of that gain is tax free, and that's how you create the CDA credit in on the corporate tax return.
Perfect. This question is one of mine. So, yesterday was in client meeting with a whole team of Big Five accounting guys,
Okay,
and
yeah, those are always fun.
they're the kind of the thinking was all about reducing the tax bill now, and
Hmm.
there was actually from my point of view, not enough long-term view from the accountants in terms of state issues, right? So, and one of the accountants even said, "Well, this isn't a problem now. This isn't a state issue, so we don't have to worry about it for the client, right?"
Oh
But
wow.
the clients, it was they had a farm and they have a
Mhm.
corporation and they've got all these different assets and what they were looking to do was transfer wealth to the kids, right? So
Yeah,
really estate
yeah.
issues were kind of number one in their mind. Is there any questions or things that you would recommend that people ask their accountants or when they're sitting in one of these meetings with their tax lawyer, their accountant, their financial planner, their investment guy,
Yeah,
uh,
good
and
question.
maybe they need to call a timeout and say, how does this affect my estate? Or, what kind of questions should they be bringing up to ensure that those ideas are covered off as well?
Yeah, good question. Man, I've worked with so many accounting firms, over certainly the last 10 years I've been here at Raymond James. And you know what? It's always a great experience. It's always meaningful dialogue, to be able to kind of correspond sorry, the better word is collaborate with the accountants on the business owner's behalf, right? Because the challenge, and I just had a meeting with one of the senior tax directors at KPMG here in the Okanagan, 2 weeks ago, and it was interesting meeting with them because their focus is really just kind of tax planning, right? And as certified financial planners, we have a broader mandate and a broader fiduciary responsibility, not just tax planning, but insurance planning, estate planning, wealth management planning, retirement planning. And to your question, I think to ask the accountant, hey, look, like we know that we're going to be okay financially. We even feel strongly and have gone through a financial planning process, and we know that our net worth is going to maintain itself and grow. But with that comes a current estate tax liability and a future estate tax liability. What advice are you giving other clients on how to address those tax problems in the future? Question mark. And it would be interesting to be a fly on the wall in that conversation, right? And now again, in defense of the accountants, I mean, you can't know everything, and that's where I think at least from the mandate of the financial planning side of our industry, we want to make sure that there's a holistic approach to address some of those other things, and that we're not making important large scale decisions with just a smaller perspective that's tax planning only, and that's not a perspective to have. But sometimes there are other considerations beyond just, oh well, we think that it makes sense now to unwind your corp. We're going to do that over the next 4 or 5 years, and we're going to try and spread out your tax liability, and we've reduced your recurring costs for legal and accounting for the next 30 years. You're good to go. And that isn't always the best decision, right? But I think collaboration is always the best way forward. And unfortunately, there's not enough of that across the industry. And so I'd like to think that the value proposition that certainly you and I as a team, Greg, would offer any of your clients and or their friends as prospects is, the best work that we do is in collaboration with the accountants, and we can show them, hey, here's what we've estimated as current estate tax liability. Here's what we've estimated as future estate tax liability. And back to that case study scenario that we shared with you, We were just really repurposing the growth off their investments into a strategy that helped address both tax problems. And that's maybe the point I want to stress here is if business owners are not getting good advice, or sorry, if business owners are not getting advice on those two tax problems, they should question the tax advice they're getting, because those are the two issues that are there, right? And you know that it becomes very quickly prominent for me in the meetings I have with clients. Are they getting tax filing services advice, or are they getting advanced tax strategy planning advice? And there's a massive difference, a chasm, in fact, between those two services.
For sure. And that kind of leads me into the next question. Um, so a lot of what we talked about today is people that already have multi-leg strategies in place, corporation with investments, maybe already some life insurance policies, maybe even already something within the corp. Are
Yeah,
there things that people like now, shifting gears and speaking maybe to the young entrepreneurial
yeah, yeah,
types who might be just starting out, are there some sort of benchmark things where, a certain level of retained earnings in your corp where you want to start,
yeah,
booking these calls and these meetings to get started? And then, are there some strategies for someone starting out? What comes to mind is like a small participating whole life with a guaranteed insurability rider,
yeah,
to just kind of earmark that potentially if it becomes reasonable, they may want to employ something like this down the road.
yeah.
But there's maybe something that they could do in the meantime that also provides some other benefits.
Yeah, great question. And how do we maybe provide advice to maybe, position clients to take advantage of that planning later, even though they might not necessarily be able to take full advantage of every aspect of the planning now? I think maybe that's the spirit of your question. Is that right?
Yeah.
Yeah. So uh, in some cases, we're just suggesting that, the associate dentist, let's just set up some term insurance, right? Their career is 25 years ahead of them. And let's get some insurance in place for the family, for their spouse, for their kids. So that if something were to happen, we're ensuring, their ability to pay down debt and replace their income if something happens. So the reason I use a dentist is this was a very good friend of mine. This is what we did, back almost 18 years ago. We set up a couple of $1 million of term insurance. He owned it personally. He was working as an associate for a dentist. That dentist eventually retired. As the associate, he bought the practice. We then transferred the term insurance into the operating company so he could at least fund it with his more efficient after-tax corporate dollar. Then, as he paid off the dental practice over time, that money, that was going to pay off debt was now accumulating two, three, $400,000 that then was flowed up to a holding company that was set up. We transferred the policy again. And then it was at that time, once significant amount of money started to build, that we then converted it into that policy that we shared and talked about today. So we can set up even simple term insurance as a risk management strategy, but we can take a caterpillar and through a series of ownership changes, turn it into a butterfly down the road, depending on their situation. So even getting some term insurance in place, when you get term insurance, every carrier has what they call renewable and convertible. Renewable means, if it's a 10 pay or a 20 pay, it's going to renew it at a slightly more expensive rate, but it's at least level for a period of time. But the convertible part is the interesting part, where we can then convert that into a strategy where they may not even need to necessarily qualify health wise later, because we've seen that too, where they haven't been able to qualify later, but had we been able to get the planning in place earlier when they were healthier, we could have got more preferential pricing, and we wouldn't have to deal with having to get qualified. And sorry, and that's an important point I did not make earlier, is we'll meet with clients, we'll educate them on this, and then they'll say, okay, let me get this straight. I can set up a policy, I can do it in my corp, I can overfund it, I can build an investment. That investment is vested and locked in every year, so it never goes down, and then I can generate a pension off of it. What's the catch? Sounds too good to be true. Like, what is the catch here? And the short answer, one of the short answers to that question, is people need to be able to qualify medically to set it up. And so, to your questions, even just doing some of that base risk management planning with more simple and cheaper products that we can then that we can then evolve and massage into something different is pretty common advice.
Awesome, perfect. Well, there's no more questions that have come in, Uriah, so we'll call it there for today. Thank you so
Okay.
much for your time, and always a pleasure hearing about these strategies and your answers to the questions were all fantastic. If anybody has more questions or they want to dive in further with Uriah or myself, just reach out via email. And we'll make this available for a replay if there's someone you want to share it with as well. So yeah, thanks everyone for attending today, and watch out for the next webinar coming out next month.
Thanks for having me, Greg. Take care, everybody.
Take care. Bye for now.